Hey, Kookie, here we are again, mate. It's a bit a little bit confusing for me at the moment in terms of how long interest rates are going to stay where they are. When will they start to reduce rates? How hard have all these interest rate rises actually bitten into the economy? And I know, no doubt, we'll look at your chart a little while down the track, but it's a bit confusing. It's like there's parallel economy sitting out there.
It's a grey area, as when we get to
grey
the
peak. Grey is actually the important word, because it is the grey people, the older people over 50 who are seen to be not affected by what's going on.
Not affected, they're actually benefiting. Their house prices going back up. Their term deposits, which 2 years ago they were getting 0.1% if they were lucky, they're now getting 4.5% or 5% if you shop around.
Yep.
And they're the ones that are doing well with this interest rate hiking cycle, rising house price cycle. And it's the younger folk, I'll call them sub 50, this is being very general, with kids, with a big mortgage, with only a moderate wage increase, no savings in the bank to benefit. In fact, they're paying more. You've got this situation where there's sort of like a two-speed economy occurring based on, do you own a house and have your money in super and some term deposits, versus you're still working, your real wages are still falling, you've got a mortgage, and your cost of living is going up. So that's the divergence. So some people are doing fine, but a big chunk of the population are not doing fine.
So can we just look at, because I mean the bottom line with what the Reserve Bank does is that they try to manipulate our behaviour. And it really is a psychological game. It's a game of psychology, game of behavioural science. How do we stop enough people from spending enough money such that vendors of goods or services will feel as though they can continue to put their prices up? In other words, they stop putting their prices up, in which case inflation comes under control. So if you look at our country, Australia, maybe this applies to the rest of the world, but let's just look at Australia. We have those people, as you just mentioned, over 50, who, up until now, if they had money in deposit or if their mortgage is right down and their property was gone right up, it doesn't matter if it's come back in the last 12 months by 9% or 6%, whatever the number is. I mean, they bought it 15, 20 years ago. It's doubled or tripled.
Yes.
So they feel rich. So it's about how they feel at the end of the day. Has the Reserve Bank actually sat down and worked this stuff out? Like, have they worked out who are the people who feel rich and who are the people who don't feel so rich?
They have, and that's a really telling point. And so just recently they put out this research paper that showed the winners and losers from rate hikes. Because again, the Reserve Bank get lots of letters from people when interest rates were very low. Hey, I've saved my money all my life, and we're only going back 2 years ago. I'm getting 0.1% per annum for my savings.
You can't live on it.
You can't live on it. So even, just say you got 100 grand in savings. So you're doing okay. You got a chunk of cash in the bank, 0.1%.
$1,000.
Yeah. For 100.
Pay tax on $1,000 you pay.
You end up with nothing, $10 a week.
Yeah. Or and then add inflation to it.
And you're going backwards. Now, as we were saying, you get 4.5%, maybe even 5% if you go to one of the banks and institutions who are offering decent interest rates. You're now all of a sudden getting a chunk of interest that you can actually live on. So there's that part of the population are benefiting from higher interest rates. And indeed, they're cheering when the RBA's been hiking. But there's a bigger cohort of the economy. There are more people with debt. Mortgage debt is bigger than savings. So when interest rates go up, it's that cohort that have got their mortgage debt, and indeed small business debt too. A lot of small businesses have got an overdraft and they pay interest, of course. They're the ones that are getting crunched. And that's the reason why consumer spending's weakening. So you've got this divergence between, I'm being very general here, oldies who own a house with a lot of money in the bank and maybe they're super all nicely tucked away, versus the young folk who, obviously, their super's tied up. They can't touch it. They took out a mortgage a couple of years ago. House prices, they're up a bit, down a bit. They're not doing much. And their real wages are going backwards. That is the big issue that's hitting them. And as you said, it's that animal spirits. It's, so some people are feeling good and they're spending, as I think we were chatting just before we got on air. Go to the airports, it's the older cohort that are holidaying. They've got going to fancy hotels and eating nice meals and jumping on a plane somewhere around the world. It's the young folk that are sitting at home and eating baked beans on toast because they've got, this financial stress.
And does anyone ever consider the fairness of this?
Some people do.
No, but we're talking about the RBA. or in government?
Well, it was interesting when Dr. Lowe, the now ex-RBA governor, left a week or two ago. He gave a sort of an exit speech to the community, and it was a good speech. It was worth a read on his reflections of his time at the Reserve Bank. And he said that there is an element of unfairness. He, or the Reserve Bank governor, have only one tool, and that's interest rates. They can't make interest rates lower for someone with a mortgage, higher for someone, who's got a business loan. It's one interest rate for the whole country, or have a different interest rate for Perth as opposed to Broken Hill as opposed to Tasmania. It's the one interest rate for the whole country.
So he was flawed.
Yes, which is where the government can and should, to be blunt, and only occasionally does, to be blunt again, manage that unfairness.
Through fiscal policy.
Correct. Through taxing, spending. Who do we, the budget numbers came out the other day. Yeah. The government spending and taxing per annum is $600 billion per annum. $10 billion a week they tax and spend. That's a lot of money that's going around the economy from the government alone, the federal government, not even counting state governments. So they can sort of say, well, we realise there's a problem there, so maybe, well, let's say old age pensioners, they're doing it tough, the cost of living pressure, the price of fruit and veggies and electricity's gone up. We'll bump up their pension by an extra X dollars per week to compensate them. Fair enough. I think that's a decent thing for a country like Australia to do. Whereas maybe superannuation, and this is where there's going to be a hot debate, I'm sure, coming up in the next couple of years, is very generously treated by the tax system. So if you've got, a chunk of cash in your super fund, you're actually benefiting at the cost of people who have to pay higher interest rates because the RBA is trying to control inflation. So, gosh, we're getting into a really complex area, but it's one that I think needs to be addressed because the interest rate lever that the RBA pull, both up and down over time, impacts different parts of the economy so differently, and that can be very unfair as we're seeing right now.
Right. So can we just look at inflation for a moment, just for 1 second? Or more importantly, the calculation of CPI, which is a calculation of inflation. Yep. Right now we're seeing the Saudis and Russia increase the price of oil. Well, they're not increasing the price of oil, they're reducing the output, so which by definition increases the price because it reduces the supply, the demand remains the same. So the price of oil goes up, which means the price of petrol goes up, the price of all those inputs go up here in Australia, which, is inflationary in itself, okay? That's one.
Correct.
One thing. And let's look at, there's any number of other things that somehow get imported into our economy that interest rates will not control. And I just want to just broadly paint a picture for you.
Yep.
So if I'm driving my car and I'm driving my car one petrol tank per week, I've got to buy petrol. Sure. I need my car for work. Yeah. So it's not something I can say, I'm going to stop spending my money on that, okay? Because interest rates are too high. I wonder whether at some stage that they will exclude from the definition or from the calculation of CPI at some stage, and I'm not talking about trim mean, I'm just talking about just generally exclude it. Things that interest rates, I'm talking about the RBA, things that interest rates do not change. So interest rate changes, even if they put the interest rate down to 0.1% again at the official rate, I'm not going to go and buy more petrol.
That's right. Yes, it's not correct. You're just going to and from work and a little bit around on the weekend.
Correct.
Yep,
I might say, I'm not going to drive on Saturday because I might try and save a half a day's petrol, but it's highly unlikely.
Yes.
So, and there are a number of these items, like electricity into my home. The amount of power I use. Correct. I mean, I might go around and turn the lights off, but it's marginal. Amount of gas I might use, or I might decide not to have gas in my house, but the amount of gas I might use in my house.
But things like council rates, if you've got your house, I've got to pay it, whether I like it or not. They put them up. There's nothing you can do to change that.
That's
or insurance, unless you say I'm not going to have insurance, which of course is
but you have to have insurance. If you've got a mortgage, you've got to have insurance.
Correct.
You've got no choice.
When the insurance premiums, which have been going up a lot this last year or two, you cannot avoid them. It's not like I'm not going to go to a fancy restaurant. I'm going to save a couple $100 a week by eating at home rather than going. That's a discretionary thing that you can change, and that's fine. But when these things, and I think you're touching on with the Saudi cutback in production, that jump in petrol prices, the oil prices, it's a global issue. It's nothing to do with Australian demand, And so I think, or the US demand either.
Of course, we talk about interest rate being a blunt instrument in terms of controlling inflation. Is inflation a blunt instrument in terms of determining what we do in relation to interest rates? I mean, it's two blunt instruments.
Yes, it's the chicken and egg sort of story, because that is actually a really valid point. Now, I know you said don't look at trimmed mean inflation, because that trims out some of these volatile items. So again, last year, when the price of lettuce went up to $10 a lettuce because of the floods in Lismore and around the veggie growing area of northern New South Wales, the RBA said, look, we're not going to hike interest rates because lettuce prices have gone up.
But I think that's fair enough.
Again, yes. So I think it's absolutely appropriate, because now they're back down to $2.50 because they're growing again.
But don't buy lettuce.
Buy cabbage instead.
Correct. Go without lettuce. But I can't go without petrol. I can't go without electricity in my house.
Correct. And that's where the impact of things like petrol, and again, I'm old enough, and with all due respect, you're probably old enough to remember the mid-70s oil price shock. Central bankers there saw that when the OPEC, Organisation of Petroleum Exporting Countries, got together and said, look, let's have a cartel. Let's restrict our supply of oil. And the oil price, if I remember correctly, went from like $5 a barrel to $20 a barrel, like a massive increase. Central banks saw this inflation coming, and they hiked and hiked and hiked interest rates. And we almost, I won't call it a 5-year recession, but basically 5 years of absolute horrible economic circumstances from the mid-70s through to the early 80s. Because central banks were trying to control that inflation, which came from nothing to do with what you and I or the general public are spending on goods and services. And it crunched the economy. It was an error. And that there's been 1,000,001 academic articles written on it now. Don't hike interest rates when there's one of these, what do we call it, exogenous shocks from something like oil. What you do, so the point right now, and this is a really interesting point, that this oil price bounce that we've seen in the last, 2 months, $2.20 for a litre of petrol. Yes, I fill up my car. I don't drive any more or less. I drive, for work and other things. It is impacting on CPI inflation. It will for the next couple of months. But it's interesting that just in this, since we met last time, not only of the RBA, but we've had the Bank of Canada, we've had the US Federal Reserve, we've had New Zealand, all being on hold. So they're saying, and they're not silly. They're the ones who've learned from that experience, 30, 40, 50 years ago. And they're seeing this inflation come through, but they know that they've already got a lot of hikes in the pipeline. And another one is going to cause you or me to drive more or less, and it won't put any pressure on oil prices. You mean they
put a lot of hikes in the pipeline already?
They've already got, apologies, yes, they've got a lot of hikes in the pipeline. Another one or two, no, we don't need it. We know that inflation is going to pick up because of that mechanical pass-through into the CPI, the inflation basket's going to be pushing up the inflation rate, but you don't tackle that with higher interest rates. And indeed, all it will take is for one of these people in the OPEC cartel to say, hang on. Because they're not altogether good mates, all these people. Even though they sort of act together, there's a bit of skullduggery that goes on. All it'll take is one or two of them, or the Americans themselves to, ramp up fracking and these sorts of things, and the oil price will be back down. Whoops, we hiked interest rates and now the CPI has come back down. These oil prices are very fickle. They're very volatile. You don't hike or cut, for that matter, based on an oil price move.
I get it. I understand it. But why can't the Reserve Bank adjust the inflation number, or more importantly, why can't the ABS break ranks and say our calculation methodology from now on is going to exclude certain things that we know everybody's going to have to do, and no matter what happens, we don't control the price of. Yeah. And I know everyone's going to say, we don't like to interfere. We want market forces to operate, naturally, et cetera, et cetera. But it also creates quite a bit of tension and anxiety in the marketplace. It gives the media a whole lot of stuff to write about.
Yeah.
And the media itself will create a whole lot of anxiety about, oh, the inflation's up, does that mean interest rates are going to come up? Can we eliminate, where's the case for eliminating that question and even coming up? Like, let's be realistic about it. I mean, and when will someone ever do a review on how CPI is calculated? Ever?
The ABS do it internally. But what they do, they base the weights, so petrol and lettuces and insurance and beef and vegetables and insurance, all that sort of stuff. They base it on the household expenditure survey. There's a similar argument that applies to tobacco. Only 10% of people smoke now, which is a very good thing. So smoking rates have come down, but the price of ciggies has gone up. I can't remember what they were, but they're about $40 a packet.
Yeah, $50.
50, whatever it is. I don't know, but because of tax. Now, again, the price of cigarettes has gone up massively. That feeds, and cigarettes are in the consumer price index. They're in the inflation rate. But what the RBA does, of course, and that's a tax issue. So they're not going to hike interest rates because the price of ciggies has gone up, because the government's saying we want fewer people to smoke. So
it's not because of demand.
No, nothing to do with demand. In fact, demand's falling, but the price has gone up because of the tax. So so in theory, you should take out tobacco. And because so few people smoke as well, more people rely on petrol either directly, I drive for work, or indirectly because the big supermarkets and everything that's in a shop is brought in on a truck. And so the logistics companies, or on a plane, the transport logistics companies, they're now starting to squeal because the cost of filling up your big truck full of diesel that goes between Sydney and Melbourne and Brisbane and Adelaide and Perth has gone up just because of what's happened in Saudi Arabia. So they're going to say, well, hang on, I'm not making any margin. I've got to put up my prices. So Coles and Woolies will have to put up their prices to cover these transport costs. For a packet of cornflakes, cornflakes are exactly the same, but my transport costs have gone up, so I'm going to bump on 10 cents a packet, which, of course, is inflation.
Well, and I guess what we're saying here is, therefore, it's not a very great science. The science or therefore the methodology around. I understand the philosophy around controlling inflation, but the methodology of calculating inflation, against which we get interest rate increases or decreases, for that matter, which affect various parts of the economy differently, as we said right at the very beginning. The whole thing is inexact. It's not a very good science, in my opinion. And I think the conversation should be had. I mean, all of us consumers, we just cop it in the neck. We just sit here, we take it. There's the number, there's the read. There is no. They do not create a narrative between the consumer who feels the effect of it and those who create the effect. So has this ever happened anywhere in the world?
Not really. Not that I'm aware of. It does come down, and again, I don't mean to be down on Philip Lowe as the last RBA governor who just recently left, but his communication was one of the problems that caused him to, lose his job, basically.
Misfoot.
Yes. Whereas people like Glenn Stevens, the prior RBA governor, even though he was a very dry sort of character, he explained things very well. And he got the Reserve Bank to publish more research articles on things like the inflation rate. And so if you look back, and I'm hoping Michelle Bullock, the new RBA governor, does that. I'm hoping she says to her research department, don't forget there's 500 economists. My gosh, what the fun times they must have at lunchtime. But there are 500 economists. So Michelle Bullock, governor, okay, economics team, I want you to listen to Mark. Can we put out a research paper that explains why inflation? Okay, we've got a cost of living index, which should include petrol and cigarettes. Some people smoke, some people don't.
100%, yep.
That's fine. But then can we also get together something different to the trimmed mean and these other esoteric measures, but get to something that is, what do we call it? A demand-driven
price rise.
Price changes.
Price change, yes, yeah.
Demand-driven.
As opposed to, it's not driven by demand.
Correct.
Yeah.
So the price of, let's have a think about it for a second, and supply, of course. So the price of meat, the price of restaurant meals. So if you go to a restaurant or no one goes to a restaurant, they're not going to put up their prices. But if everyone goes, they're going to put up their prices, and, that's inflation. So it is demand-driven for things like that. So and some people even argue like established house prices should have some weighting in the inflation rate. At the moment, they don't. It's only the cost of building that's in the inflation basket.
Cost of dwelling.
Yep. So the bricks and mortar and the timber and all that stuff that goes in, of course, the fridges and washing machines and stuff like that, they're in the inflation rate, as they should be. But established house prices aren't. Some people say that should be in there because, they're part of our cost of living. But the Bureau of Stats say, oh, no, there's such an infrequent transaction. Most people don't buy and sell a house more than once every 10 years. So it's sort of a bit wrong to have it in there. So getting back to the point, the RBA could easily, and they've got the people to do this, and they probably have it actually, they've got this work done, but they don't publish it, but put it out there. So Michelle Bullock or the new deputy, whoever that may be, give a speech every few months. Here's an update on our inflation thinking.
And what we're thinking.
Not just the headline inflation rate or the trimmed mean. That's fine and that's good. Yeah, I absolutely appreciate those sorts of comments and research from the RBA, but actually dig down into some of these other things that, saying that, a rate hike won't impact the oil price. So we're not going to, so you can rest assured that, because the price of petrol's gone up from, $1.80 to $2.20 or whatever it is, because of a Saudi production cut, that is not going to impact our considerations for interest rates.
And people are in the know then, and they can get less anxious.
Yes.
I mean, for those
or
who
when
are
the price
interested,
falls back down, which it will one day.
they're not going to put interest rates down.
We're not going to put them down. No,
No.
not putting them down either, because that's a shock from outside Australia that's got nothing to do with our monetary policy.
So my point, therefore, remains, and I think your answer to my point is that, or your comment on my point is that this stuff probably does happen inside the realms of the RBA and behind the closed doors. Maybe the answer here is a bit more, not transparency, probably not a good word, because this suggests that there's lack of transparency. Maybe what we should be getting is more publications based on what they're doing, a little bit more conversation between us and the RBA around their thinking. I'd actually like to see go back into the ABS, the Bureau of Statistics, too, because I don't think they should be immune from this either. I mean, I just think it's a poor excuse for statisticians to hide behind just statistics and not actually, when statistics are used to change behaviour. I think they should be responsible for the statistics that they produce in relation to the behaviour that they're going to affect.
I think that's important too. And the relatively new, that David Gruen's the chief statistician, the head of the Bureau of Statistics. He's been there for a couple of years. And during the COVID lockdowns, they changed a lot of data they collected to sort of having very timely data on payrolls numbers and things. They don't get a lot of coverage in the media, which I'm disappointed about as an economist. I look at them, but there's little snippets of information. They don't have a long history. They've only been going a couple of years, so you can't really work out business cycles and things like that. But he's ramped up what the Bureau of Statistics does. And he's also ramped up a little bit some of the commentary. So there's here's the data with all 50 pages of tables for people to look through. But he's also for some of the important releases, put out a little press release. So whoever the person who compiles the data says, oh, this was the weakest retail sales number in 2 years, and the drivers were, Taylor Swift ticket sales, or something like that, or what's that thing called? Black Saturday sales at the end of October, Black Friday. Apologies, I'm not a big shopper, as you can probably tell.
November.
End of November, yeah. So they identify stuff like that when there's a one-off special thing, or even just when school holidays change, because they sometimes fall in March or April. That can change the March and April numbers because people spend more when they're on holidays than when they're at home or at work. So they identify stuff like that. Great. So when I see a number, oh wow, that was a really weak number. Oh, that's the reason. It's not as weak as it appears because school holidays are in March, not April this year.
It's nice to have it confirmed. Well,
it is.
Well, speaking of all that, let's get down to our real simple, this is pretty simple, straightforward decision-making table or criteria about where we think interest rates are going to go. Let's talk about that now.
Okay, the monetary policy checklist, Mark. And look, I think I'll start at the end again. Rates are on hold when the RBA meet next week. So GDP, we had it from the Bureau of Statistics that quarter-on-quarter growth was 0.4% for 2 straight quarters, 2.1% in annual terms. That's a little below trend, but it had to slow down. It's what the RBA wanted to see, so they'll be happy about that.
So just to clarify, for the last 2 quarters, what has been the growth again?
0.4, 0.4, 2 consecutive quarters.
So like if you extrapolated and said nothing changes for the year, we've got less than a 1% GDP growth.
We've got it slowing to 1.5 or thereabouts.
Yeah.
That's low But remember, it was very high post-pandemic.
Yep.
So it's sort of what we had to happen. If we're sitting here in 6 months and it's still coming in at 1.5%, that'll be in the easing column.
Right.
It's sort of the adjustment we had to have.
Yep. I think
Slow down we had to have, not the recession we had to have, I hope. Inflation, look, I'm putting that still in neutral to tightening. It's come down. The big discussion we had on commodity prices will put a bit of a floor under the CPI. Not that it's going to change monetary policy thinking all that much, but it'll still have that elevated level because of oil, even though non-oil inflation is continuing to fall, not only here in Australia, but around the world.
But what you're saying, Steve, is that it's not going to allow them to reduce interest rates.
No.
But it's also not going to, it's not, they'll excise it out of the decision making in terms of whether they should put it up or not, put interest rates up or not.
Yes, we're not anywhere near a rate cutting cycle, I don't think yet. Yeah. And I think that's important for us to talk about that. Yeah, just because rates are not going up, it doesn't mean they're coming down.
Okay, just the last 2 quarters, what have been the last 2 quarters?
Last 2 quarters for the CPI, well, the last one was a 0.8.
Yep.
Which was the lowest in about 3 years because we had lots of 1.2s and 1.3s. So the 0.8 was actually, and if you annualize that, that's 3.2. So just above the top end of the target range. Yep. We get the next official CPI at the end of October. So we'll hopefully be able to talk about that next time.
That's the next quarterly.
The quarterly one, but the monthly numbers have gone down below 5%. So all the figures 5%. Are the 4.9 we had below 5. 4.9 was the monthly annual CPI.
Yep.
So we've got it going in the right direction, but to get it to an easing, it needs to be well and truly in the 2 to 3% range, probably at the bottom end of that range, and we need some of these other things to be turning as well.
Okay, right up.
Labour market. Well, one thing that we had last month in terms of the labour market numbers was confirmation of unemployment at 3.7. We had a big jump in employment, but there's, a school holiday effect, according to the Bureau of Stats. So I'm putting that in neutral. I like low unemployment, so does the RBA, but it's stopped falling and it's creeping higher.
The question remains though, is what is low unemployment?
Yep.
Last time we met, we went through the non-accelerating inflation rate of unemployment, NIRU, which they're talking about 4.5%. The RBA would like to see it or have modelled it at 4.5% at some stage. So, at 3.7, that might be considered to be hyper unemployment. It's hyper low in unemployment.
It's very low still, but when we look at things like job vacancies, they're trending down.
Yeah.
And in fact, there's a very nice chart. I can't remember who did it. One of my so many emails I get that showed the correlation between, I think it was the Seek measure of job advertisements, the Seek, the labour hire company, and unemployment rate with a 6-month lag, because labour market's like the old oil tanker. It takes a long time to turn around. But in 6 months' time, they're forecasting a 4% plus unemployment rate, if that correlation holds.
Yep.
Now, that's softening the labour market showing up in wages. We had wages numbers, again, 0.8.
We're talking about wages growth index.
Wage growth index, 0.8% quarter on quarter, 3.6 annual. Beautiful. It actually ticked down a little bit. And yes, if you sort of waved your magic wand or your Goldilocks, not too hot, not too cold, just right. Happy, neutral, don't do anything. International economy, I'm going to put that more in neutral. I think last time I had it verging on easing, but the numbers just in the last month have been a little bit better than expected in the US. China seemingly has come through its weakness a little bit better. Things like commodity prices, which I'll touch on in a minute. In fact, I'll go to that now. I know it's not in order, but commodity prices have actually kicked higher. I'm going to put that in the neutral column as well, and that's because the global economy, the international economy, is a little better than most people were thinking. So those two things are well and truly in the neutral. You don't cut because of them, you don't hike because of them, but there's just this sort of interplay of forces going on right now. House prices still going up, the core logic numbers. Here we are, September's probably going to be another month-on-month increase close to 1% Australia-wide. Sydney's stronger. Brisbane's pretty strong. Melbourne's going up, but pretty weak at the minute. But you put house prices in neutral. The RBA is not worried about them yet, either up nor down. So we're getting a run of information in the middle here. Retail sales, shocking, weak. We're touching on that retail spending number, and while a few of the oldies are spending more money, that big cohort of renters, people with a mortgage, people with real wages falling, they're hunkering down. So retail sales numbers are drifting lower, and they have been for 6 or 7 months now. That's consumer sentiment interlinked. Consumers are feeling gloomy. Not just $2.20 a litre petrol and all these other things. Real wages, even though inflation's coming down and wages are going up, we haven't had the crossover yet.
So who's doing the surveys there? Consumer sentiment?
It's the Westpac
And
Index
NAB.
of Consumer Sentiment.
And NAB?
NAB do business confidence.
Right. That's next.
Which is down here. I'll go to business confidence. It's actually good.
Yeah.
And this is this strange, I'll put it in neutral because, again, you don't want to crush business confidence. One of the things that came through the GDP numbers, because GDP is made up of consumption plus investment plus government plus exports minus imports. You remember that accounting mechanism from Echo 101?
Yeah, well, that's...
I roughly remember that.
That's the expenditure method of...
Correct. Yep. The expenditure method of GDP. The investment, investment, private sector investment was up 11% year on year.
But it's also based on...
Business is doing well.
It's also... we should just tell everybody, business investment is non-mining mining. So in terms of... Can you just give us a quick breakdown of the two?
Well, actually, mining's doing okay because of the high commodity prices. But it's not the funny thing. The interesting thing is that there's a lot of non-mining capex, and when you dig beneath what our business is investing their money in, there's a lot of machinery and equipment, a lot of IT stuff, of course, just to keep up with the ever-changing technology in the world. Firms have to ramp up their IT spending, so that's one of the things. The way we're changing our expenditure means that things like warehousing and logistics buildings, so the building, non-residential building construction in that area is strong. Hotels, also very strong. Now, office towers, weak. But bottom line, you add up all these components of what businesses spend on machinery, equipment, buildings, it's pretty good. So I'm happy with that, and business confidence is good.
We might as well move business investment then, Steve.
And business investment, well, I wouldn't put it into hiking, but again, it's a good thing. One of the things that we've had for a while is the poor productivity. One of the reasons why Australia's had poor productivity, we haven't had enough CapEx. I'm reminded of an analogy. I use this one occasionally. If you're a mining company, you have 100 blokes, a shovel and a wheelbarrow. Go and dig out some iron ore. At the end of the day, you'll have a bit of iron ore. You spend $1 million on a big digger with one person operating that machinery, you'll dig out probably 100 times as much iron ore for one person. Your productivity is enhanced because you've invested in a digger. So that's how productivity comes through business investment. Building approvals, shockingly weak. We're not building enough houses. I know the government's got that plan to build 1.2 million dwellings in 5 years. I wish them luck.
The general view is they won't do it.
Bloody hard to achieve. Look, as I sit here now, if I'm a betting man, I'd say they won't achieve the 1.2 million. Now, have an objective, and if they can get state and local governments to ramp up and speed up their approvals process, the land rezoning issues, they might get close, but the cost of materials is still relatively high. Even though the unemployment rate's creeping up a little bit, we've still got a relative shortage of tradies, the bricklayers and plumbers and sparkies that you need to build a house. So the building approvals are still really weak. Stock market's edged lower. I'm going to put that in neutral. It's choppy. The Fed going to hike? Are they going to cut? We've had the bond yield selling off, and that's impacted negatively on stocks, but I'm going to leave that in neutral. Current interest rates going to move slightly easing because they are restrictive. And even Dr. Lowe, on his exit speech, said that interest rates are restrictive. And if the RBA say they're restrictive, they are restrictive. They don't understate this sort of thing. So when we look at this overall picture...
It tells me we're not going to put rates up.
We're not going to go put rates up. Now, again, as we've said every time we discuss this, the items at the top have a much heavier weighting than the items at the bottom. So GDP growth, inflation, the labour market and wages, they're really important. These are not unimportant, but they don't have as much oomph in the decision as these top few. And as you can see, they're only neutral or a slight tightening bias. So overall, when the RBA sits down to have a think about interest rates, it'll be on hold, and I dare say the statement they put out will cover a lot of the stuff.
But I think the majority of consumers, Steve, are beyond are interest rates going to go up. I think the majority of consumers, borrowers, I think is probably a better way of putting it, are of the mind when are interest rates going to go down. I mean, what this is saying, this is not good news. This is okay news. This is what I call okay news. So they're not going up, but they're not going down. And because people need, a lot of these people who are, have negative consumer sentiment, a lot of people who don't buy stuff in retail sales, a lot of these people who are worried about their jobs, perhaps, if they're in the small business community, working for a small business, they're all starting to wonder whether or not the Reserve Bank is going to put rates down, and if so, when.
Yeah, that's still a long time away. It's worth talking about, but it's not worth putting your hand on your heart and saying it's going to happen in the next 3 to 6 months. It'll be much later than that. I think we need, just to go back to this checklist, when we are here and we have got this one, the inflation button has to be well and truly in neutral. The GDP button's got to be weaker. Labour market's got to be weaker in wages. Only then will you get the RBA
so that's what
genuinely considering. We're not there yet. So if I was to put numbers on these, we need GDP to be, as we were saying, 1.5% annual GDP growth.
Inflation and consistent,
yes, not just a one-off quarter. It's got to be there for several quarters.
Yep.
We need inflation again, not for one quarter, for several quarters to be 2.5%.
Yep.
Labour market unemployment 4.5%. Then they'd consider rate cuts.
Yep.
And wages growth. Well, it's 3.5's fine. They would cut rates if wages growth was there, but if wages were to pull back a bit towards 2.75%, something like that, that would get them excited about cutting rates. So we're still, oh dear, let's have a think. We're still at least 6 months away, probably 12 months away from there being a genuine debate about a rate cut. But for the moment, there's low probability, very low probability of a hike.
Okay, give me one last, Nostradamus prediction.
Yep.
In terms of money markets, what are they telling us?
Money markets telling us that there's, a slight possibility of a rate hike in the next few months. It's one of these questions that you say, if there is an interest rate move in the next 6 months, will it be up or down? It'll be up.
Yep.
But it's still less than a 50% probability according to money markets. And then we get into the futures market. This is money markets.
Yep.
In the middle of 2024 through to the end of 2024 and early 2025, there's the possibility again of a rate cut being priced in. Only a moderate one. Only
one rate cut.
We're only talking one, maybe two. Depends on just the fickleness of these money markets. They're like the stock market. They bounce around every day. We're not talking rates going back to 0.1%, and nor do we want that. That was because we had a horrible health pandemic, But so all I think that we're going to be having in the interest rate debate in coming months is we're on hold. What's the risk of a hike? Low probability. When will the first cut be? It'll be later rather than sooner. And how aggressive will the rate cutting cycle be? Not much, but it'll be done to help cushion the economy against, a hard landing in terms of GDP and unemployment.
So we might end up having a wage price index at 3.5. We might end up having inflation around 3.5. We might end up having, and if we get 2 rate reductions, we might end up having the cash rate at 3.6.
It'll be the 3.5 story, which, and it'd be great. Well, it'll be, yes, if Michelle Bullock was to say, and I shouldn't say this publicly, in 2 years' time, I've been in the job for 2 years as RBA governor, I'll call it 3. If she can get GDP at 3%, inflation at 2.5 to 3, unemployment 3.5.
3's the number.
Wages at 3.5. That'll be fantastic. Can she do it? Let's wait and see.
There will be a song about this. Not about one is the only one, but there'll be some song about
3 is the loneliest number or the best number.
Or the best number, or something along those lines. Mate, if they get if it's all
3, yeah.
You and I will write the song and sing it.
You're on. I promise you.
Thanks, Googie.
Thanks, Mark.